Today, for the SIE exam, we are covering two of the most fundamental risks every bond investor must understand, which are interest rate risk and credit risk. Let's start with interest rate risk. This is the danger that if interest rates rise, the price of your existing lower rate bond will fall. Think of it like a seesaw. When new interest rates go up, the value of old bonds goes down. The exam, however, won't just ask for the definition. It will test your understanding of sensitivity. How much does a bond's price move when rates change? The key metric for this is called duration. Duration, expressed in years, measures a bond's price sensitivity to a 1% change in interest rates. For example, a bond with a duration of 7 years is expected to see its price fall by about 7% if interest rates rise by 1%. A bond with a duration of 3 years would only fall by about 3%. On the exam, you'll be asked to identify which bond is the most volatile or sensitive to interest rate changes. You don't need to calculate duration, but you must know what increases it. Two factors are key, which are a bond's maturity date and its coupon rate. The longer the maturity and the lower the coupon, the higher in duration and the greater the price risk. A 30-year zero-coupon bond is extremely sensitive to rate changes, while a 2-year bond with a high coupon is much less so. A great way to remember this is the phrase, longer and lower is a larger loser. A bond with a longer maturity and a lower coupon will lose a larger amount of its value when interest rates go up. A common trap is a question showing 4 bonds with different maturities and coupons and asking which will be most impacted by rising rates. Don't get lost in the details, just find the bond with the longest maturity and the lowest coupon. Now let's shift to credit risk, also known as default risk. This is the risk that the bond issuer will fail to make its interest payments or repay the principal at maturity. It's crucial to know that U.S. Treasury securities are considered to have zero credit risk because they are backed by the full faith and credit of the U.S. government. This risk primarily applies to corporate and municipal bonds. To help investors assess this risk, independent rating agencies analyze issuers' financial health. The 3 main agencies you must know are Standard & Poor's, Moody's, and Fitch. They assign credit ratings that look like school grades. For S&P and Fitch, the scale starts at a pristine AAA, then AA, single A, and BBB. Moody's is similar, but uses AA, AA, and BAA, everything in that range. From AAA down to BBB or BAA is considered investment grade. This is a critical distinction for the exam. The moment the rating drops to BB or BAA or lower, the bond is classified as speculative or more commonly a junk bond. An exam question might describe a conservative income fund that is only allowed to hold investment-grade debt, and then ask if a bond rated BAA by Moody's is a suitable investment. The answer is no, because it falls just below that investment-grade dividing line. Remember, the B in BBB or BAA is like a passing grade. Anything lower is in speculative territory.